Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. Hey, good morning, everyone. I'm Mark Eitel, and you are listening to the Mr. Mortgage Show. I've got to admit, I really, really love that intro. It's quite an ego boost, I swear. I feel like I'm in a heavyweight boxing match. But anyway, so thanks for spending a bit of your Saturday with us. We come to you live every Saturday here on WJNO, and you can find us everywhere that you look for podcasts. So if you miss any of the show, or there was something that you want to hear again because it was intriguing, I can't imagine that. Maybe my mom will listen to it a second time. But yeah, check out the iHeart app. We are on the app, or you can just Google the Mr. Mortgage Show, and a variety of podcast platforms are now carrying the show. So we're super excited about that. But yeah, thanks for joining us, spending a bit of your weekend with us. We're excited to have you. Before we jump in, I don't know who saw that Super Bowl. I thought it was a good game, and there was a bunch of controversy or excitement, whatever you want to call it, around the halftime show. And I, for one, enjoyed it, but I have to admit, it made me feel old because I think even the rap was better in the old days. So yeah, it was a good show. I enjoyed it. So hopefully you had an amazing week. And yeah, let's dive right in. So there wasn't a lot of mortgage news this week. Rates are definitely in this channel. There's still a bit of upward bias, but all eyes at the moment are on Russia. So there is definitely some jitter effect to what's happening with Ukraine and Russia in the market. And the big question is, will Putin start shooting? And if Putin starts to shoot, we'll probably see a short-term pullback in interest rates. But I also think we'll see a jump in oil prices, which is going to hit inflation harder. And I don't know. I mean, I'm not big on geopolitics, but I can't imagine it being a long drawn out affair if something happens. And let's pray it doesn't. But for the moment, rates are trading in this channel and continue to do so with a slight upward bias. So I just wanted to throw that out there. That seems to be where all eyes are in the world of interest rates right now. But as I mentioned, all of the other interest rate indicators remain with a slight upward bias to the current trading channel that we're in. So, and just to kind of confirm that, Freddie Mac publishes each Thursday morning a rate report, and they just take the previous week's averages. So it is a bit of a lagging report, but they take the previous week's averages for the three major loan products, which are 30-year fixed, 15-year fixed, and 5/1 adjustable rate. And that continues to trend upward. For the first time, we're seeing it bump near 4%. So the 30-year fixed rate average report, or in the Freddie Mac report this week, was 3.92%, and that's costing almost a point in fees. So 0.8% in fees. So yeah, we are here. This is the new normal, but still some really encouraging news out there. And the reality is these are still cheap interest rates, so we shouldn't get caught up on the rate. There's no real cooling in demand, if you will. Buyers seem to still be lining up and jumping in at any opportunity when inventory hits the market. And we all know real estate inventory remains tight, but with the buyers kind of standing in line, there does appear to be some pent up demand. I mean, we saw a little bit of inventory come to the market towards the beginning of Q4 last year, but that's dried up, and we're back in that environment where it seems that if a property hits the market on Friday, it's under contract by Sunday. So yeah, if you're out looking, I encourage you to be ready. Have your pre-qualification or your pre-approval. You don't even want a pre-qualification at this point. You want a bona fide pre-approval, so you are ready to make an offer. I mean, you wouldn't go hunting without your gun. You're not going to climb all the way up in the deer stand and be 3 hours into your morning and then see a deer out there and have to run all the way back to your truck to get your gun. So that's kind of the mentality behind being totally pre-approved, pre-underwritten, and and ready to rock and roll when you find that property. So it looks like we are still in an appreciation cycle based on this pent-up demand. And I talked to Peter over at SoFloAppraisal.com, and you hear me advertise for Peter and his team. And they're amazing. I mean, they've been appraising properties for a long time in Florida. And we were just kind of kicking this back and forth with this whole inventory conversation. And he shared with me the same thing. He's seeing a lack of active listings on the market. And when they're appraising properties, they use the active listings kind of as a forward indicator, what properties are being priced for now versus what's already under contract. And by active listing, I mean something that's actively for sale but not yet under contract. And they're finding it difficult to locate enough active listings to use as comps. So just food for thought. We are still in this hot sellers market. So be ready. Some more good news is, as I mentioned in the opening, rates in the 4s. I mean, hell, even in the 5s or 6s, that's still inexpensive money. I know personally, the first home that I bought many, many years ago, I bought with a 10% interest rate, and I paid 2 points to buy that rate down to 10. And properties weren't appreciating very quickly. I did the research before we jumped on the air this morning. The appreciation cycle that I was in when I bought that house was 3%. So it still made sense to own that house, and it still provided me as a first-time buyer, even with a 10% interest rate that cost me 2 points and a near stagnant 3% appreciation. It still was better than renting. I made money when I sold the property, and when I cashed that equity out, it allowed me to move up. And that's the real value in real estate. We've talked about a lot of different opportunities and loan products and programs over the previous weeks, and it all comes back to the opportunity to gain wealth through equity and then manage that wealth through different cycles in life, be it the rec loan that we talked about to cash some of that equity back out to pay off other debt, God forbid medical expenses, unforeseen issues that pop up. That equity can be a savings account, if you will. And granted, you don't want to tap it for foolish reasons, but it's there if you need it. And then later in life, if you've built that nest egg of equity, you can capitalize on it with a reverse mortgage. So we've talked about real estate through many, many stages in life and in different seasons, if you will. But it comes down to it's beneficial to own it, even as from the appreciation cycle as a flipper to a landlord with positive cash flow, but certainly as your primary residence. And, I'm going down memory lane here, but that first house that I purchased, it was a $64,000 house in Palm Springs. That was the neighborhood I grew up in. So I bought that house. My mortgage payment was $561.65 a month. I'll never forget that. I was so proud when I used to write that check, $561.65. My brother came home from the Air Force that same year that I bought the house, and he rented a really cool apartment, and his rent was $550. But over the course of the next several years, his rent quickly escalated. They kept increasing his monthly payment every time he renewed his lease, and he was approaching $1,000, and I was still chugging away with that $561.65. And I'll tell that story one of these days because it's what got me into real estate. But when I sold my property, I cashed out enough equity to move to North Palm and buy the house in the neighborhood that I always wanted to live in. And, just a sneak peek, my brother liked North Palm quite a bit also. So he leased a condo on the marina. So he went from lease to lease, and I was able to trade equity for a down payment on the house that I really wanted. So real estate definitely still makes sense. So we're gonna move into the break here in a minute, but I encourage everybody to send us your questions. The Anytime hotline is 561-291-8569. That's 561-291-8569. You can call or text your questions to that number. And as always, I encourage you to visit the website. That's www.mr.mortgage, www.mr.mortgage. There you'll find the contact us link and can submit your questions there. Mr.mortgage, no .com. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back, and you heard the big guy. We've got to give that guy a name. Remember the announcer on Price is Right? What was his name? Roddy, or something like that? We've got to come up with a cool name for the Mr. Mortgage announcer, because I just envision this big barrel-chested gorilla of a guy that you want to listen to. So listen to him and call or text your questions to that line, 561-291-8569, or visit the website, www.mr.mortgage. That's Mr.Mortgage. So we are going to continue to rock and roll forward. I know I beat that point over the head that real estate still makes sense, but we have a tendency to see the news of the day and freak out. Rates are going up, rates are growing up. That means opportunities being missed. And I don't think opportunities going to be missed. I just think it's shifting. Maybe we don't chase down that dream house. We buy what we can afford and start to build from there. And that was the spirit of me sharing my first experience in real estate. So I think we're going to dig in with some questions. I don't know if Dom's got anything ready for us, but let me give him he's given me the thumbs up. We got a question that popped in. So what do we have, Dom?
All right. We have Brianna from Loxahatchee. Is FHA the best first-time buyer loan?
All right. Hey, Brianna, that's a great question. And I love Loxahatchee. My sister and niece still live out there, and man, that whole neighborhood, that whole area with Westlake and everything has seen such a transformation. So, but yeah, that's an awesome question. So a lot of people assume that FHA somehow means first-time home buyer. But I'm going to answer your question, but you know my style. I kind of like to tell stories about it. So bear with me as we walk through this. So FHA, so to answer your question, yes, it's a great program for first-time home buyers, and I'm going to tell you why. But it doesn't stand for anything related to first-time home buyers. The Federal Housing Administration insures a loan product that has become known as the FHA loan to encourage banks to lend money to slightly credit-challenged or slightly savings-challenged buyers, which is typically the perfect product for a first-time buyer. And so what that means is they'll allow a little more of your income, your discretionary income, your monthly income, to be allotted towards expenses. So you'll hear terms like DTI. What is DTI? That's debt to income. There's a ratio that's calculated with your total income and your total monthly debt. That ratio determines whether a conventional program, or in this case, we're talking about an FHA program if you qualify for it. So the DTI, the higher the DTI, the larger percentage of your income is spent on your monthly debt. With an FHA loan, the guidelines allow for that to be a higher number. So oftentimes the first-time buyer needs that flexibility to qualify. They need a little more of a DTI ratio to qualify. Also, too, you can qualify for an FHA loan often with a slightly lower credit score. Again, the Federal Housing Administration is insuring this loan, so they're alleviating the risk from the lender. So they're encouraged to loan you the money, and that's why they're willing to do it on slightly, and I say slightly because this isn't a cowboy loan, slightly looser guidelines than a conventional loan. And one really cool part about the FHA loan is it typically carries a slightly lower interest rate. And for all the reasons that we just mentioned, the risk is greatly reduced to the lender when they fund an FHA loan. There's one downside to an FHA loan, and it's really the only downside, is the mortgage insurance. Now, we talked in length last week about mortgage insurance, and you may recall that mortgage insurance is that piece of your monthly payment that pays for the insurance policy that insures the risk to the lender. So you're paying the PMI or MIP or MI, remember we broke it all down last week, with an FHA loan indefinitely, right? So as long as you have that loan, you're paying that monthly mortgage insurance as part of your payment. The only way to get rid of that is to refinance at a later date into a conventional loan. So if you buy a property today and you've got a historically low interest rate, you're going to have to refinance that down the road to drop the mortgage insurance. And sometimes it's a significant part of your payment. You know, it depending on the loan amount, it could save a couple $100 a month to drop that MI. So with a conventional loan product, once your loan balance reaches 78% or less, and that can be accomplished one of two ways, and we talked about this too, appreciation or principal reduction. Just by you making your payments each month, your principal balance goes down. Once that number hits 78%, and the lender requires it to be at least 12 months in some instances. It used to be 5 years, but check with your lender. You can petition to, and by petition, it's a phone call, right? So you call and request that the mortgage insurance be dropped. They may require an appraisal, but if there's enough appreciation that they can use what's called a desktop appraisal to get a firm value and determine that you are indeed less than 78%, they'll drop the mortgage insurance automatically. So that's the only downside to an FHA loan, is that mortgage insurance lives with the loan indefinitely. But it's a great loan product for a first-time home buyer who needs to stretch that MI a little bit or has a slightly lower credit score. Great loan product, and I certainly encourage you to use it if you can. We have a standard practice at the Mr. Mortgage team where we'll try to start with the best program first. So we're going to try to get someone approved with a conventional loan. And one last thing, I guess, about FHA is it's a 3.5% down payment, and you can use gift funds. So your parents, grandparents, a close family member can assist with gift funds for the down payment. And conventional has a program too, very similar. But the benefit, as I mentioned, of the conventional is you can drop that mortgage insurance. So great question, great loan product for the first-time home buyer because of that additional flexibility. So, and I'm super excited for you as you start this journey towards home ownership, because as we mentioned, it makes a lot of sense. And I wanted to share a story, and I'm going to try to make it short because my stories go long. I was in the lobby of my building yesterday, just leaving for the day, and there's a law firm on the second floor, and out of the elevator came three of the ladies that I meet them in the lobby regularly, so I know they're all paralegals upstairs. And based on their appearances, I'm guessing, mid-20s, maybe 40, and then there was an older of the three was probably in her mid-60s. And the younger girl was super excited that she had just signed a lease with her two roommates, and they're each paying $800 a month. So I did some quick math in my head and figured, you know what, she's paying $2,400 a month for rent. The lady that I'm guessing was about 40 said, my first apartment was $800 a month and it was just me. And the woman that I'm guessing to be in her mid-60s kind of chuckled and said, my first mortgage payment was $800 a month, including everything. And that's where the conversation ended, or at least for me as I walked to the car. But it got me thinking that somewhere in the future, and maybe not the distant future, that 20-year-old girl is going to be chuckling that her rent was only $2,400 a month, or that her mortgage payment was only $2,400 a month. And that got me to do a little Google research, and I double-checked a couple things. So there's a website called Zumper, and it's a rental reporting site. And they reported that the average rent in West Palm Beach was $2,855 a month for a 3-bedroom apartment. And 61% of the landlords surveyed in West Palm said that they plan on increasing the rent this year. So really quickly banged out some math, and I found a $350,000 house. And granted, it was in Port St. Lucie, not West Palm. But with a 3% down payment and $200 a month going towards a homeowners association, you could buy that $350,000 house for just $28.41. So less than rent. $28.55 was rent, $28.41 was the mortgage payment, using an FHA loan as a first-time home buyer with just 3% down on a $350,000 house. And just to stretch that out, appreciation at 8% over 5 years would net you $164,000 in equity if you were to buy that house instead of rent. So we're going to be on the other side of this break. I hear the music rolling in, so that means I need to get moving. Continue to send us your questions. Call or text 561-291-8569, or visit the website www.mr.mortgage. That's mr.mortgage with no .com. It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, so we are back. That's 561-291-8569. 291-8569 is the Anytime hotline. And anytime that you want to jump on the internet and find us, it's www.mr.mortgage. That's mr.mortgage with no .com. So just to kind of finish the thought up on that appreciation, I know I kind of snuck that in at the end there with, 8% appreciation would net a significant return after just 5 years. And a lot of people are waiting for appreciation to slow. But I read an interesting article this week that, and I'm not going to go into length on it, but so why is appreciation still why is there so much demand pushing pricing up? And I think there's two different things happening, right? One is, there's demand, as we talked about, that there's just not enough inventory. But there was an interesting article that Redfin did a study, and it was the mortgage broker or I don't remember who it was. I printed it out here, but the National Mortgage Press, I think it was, ran the report. And out-of-town buyers are paying on average 30% more for properties than locals, if you will. And what's happening is, and this isn't rocket science. We're seeing it in the news. People are moving from more expensive regions, cashing out a big piece of equity, and its perceived value. They come down to, Florida, and the properties in their mind are half price. Everything's on sale. And the local people are like, wait a minute, this is all-time appreciation. We're getting priced out. So, you've heard it said that perception is reality. And I think that's what's happening. I think the perceived value of, to use Brianna in Loxahatchee, I'm close with my sister out there, and there's a spec home going up by her on an acre and a half for $1.1 million. And if you're moving from the city of New York, that probably feels like a bargain. I've got this big piece of property. I've got a canal, which, is a glorified drainage ditch, but nonetheless, a canal in my backyard, and this big, beautiful 5-bedroom home. Yeah, 1.1 million's a steal. So perception is reality. We know that. And these prices, as you cash out of those northern markets, are still a perceived value. So I think that has a lot to do with our local market anyway. And the article covered many, many metros, but one in particular was Nashville. And I guess a lot of people from Los Angeles are moving to Nashville or that county. I'm not that familiar with California, but nonetheless, the average sales price from that location was $950,000. Yet the average purchase price, in Nashville was only $411,000. So you can see how that perceived value exists for that out-of-town buyer. So let's jump into some more questions. I saw some pop in. I think Dom has one queued up for us. What do you got, Dom?
Yes, we have Michael from Pompano. Michael said, so last week you said I could borrow 90% without having to pay mortgage insurance. But I asked my mortgage guy, and he said, that's wrong. What's up with that?
Hey, Michael, I love the swagger in that question. So your guy's wrong. That's just the reality. And in his defense, not a lot of lenders have the program. It's a fairly new program. But I assure you that a 90% loan with no mortgage insurance does exist. And it's a powerful tool in this market that we're in. Just from the very basic stance that you can put less money down on a property and not to have to pay that pesky mortgage insurance, which, we've beaten mortgage insurance over the head the last couple shows, but that doesn't benefit you. It only benefits the lender. That's insurance against risk. So yes, your guy is wrong. There is a 90% loan with no mortgage insurance. And as I mentioned, it's, for a lot of reasons, a powerful tool, but I want to share a real world story with you. And this is a property that is a borrower that we're currently working with, and they're buying a property down in Weston. And it's a townhouse. And I want to use this example as it is current and real. So we've all heard about appraisals not hitting the purchase price, and then that causes a whole domino effect on the buyer needing to bring more money to the table, or in this case, borrowing a bigger percentage and having to pay that pesky mortgage insurance. So we're using the 90% loan with no mortgage insurance in this exact example. So it's a $370,000 purchase price. And this borrower is intending to put 20% down. So her intent was to put $74,000 down and take a $296,000 loan. Now, she has the money to do it. So there's a lot of, ability to work within these programs here. But her whole reason for dropping 20% on this property was to avoid mortgage insurance. She's, very fiscally responsible. She's conservative. Her mindset is a bigger down payment avoids that mortgage insurance. Brilliant, brilliant strategy. Here's the problem. The property only appraised for $330,000. So as we talked about in an earlier show, the lender is going to use the sales price or the appraised value, whichever is less, to determine how much they'll loan. So now she's going to borrow 80% of $330. Now, in order to do that, there's a big piece of the puzzle missing. She's going to have to tap her 401k, which she doesn't want to do, to put more money down. So dun-da-dun-da-dun, the superhero loan, if you will, comes flying in to save the day. We use the 90% no MI loan. Her objective is met. She's not paying mortgage insurance. And so here's the math. This is really cool. Follow me here for 1 second. On a $370,000 purchase. Now, these are round numbers, no closing costs, no, title insurance isn't in here. So just give me the grace of working in round numbers to explain this. But a $370,000 purchase price with an intended 20% down payment is $74,000 down and a $296,000 loan. But as we mentioned, it only appraised for $330. So if we use that 90% loan, she's putting 33% down against the $330. Now, I know she's got to put more down because the purchase price is $370, but bear with me. So $370, 20% down is $74,296 loan. Here we go. $330 is the appraised value. The lender only requires 10% against the appraised value because it's less than the purchase price. That's $33,000 down, which qualifies her for a $297,000 loan. Now, I rounded it up because there was some loose change in there, but that's the same loan amount. In the other scenario, it was a $296,000 loan. That leaves $41,000 to bridge the gap to get it back up to that $370,000. So do the math. A $33,000 down payment and that $41,000 that's necessary to bridge the gap is the same $74,000 that she would have put down. So in this instance, she's putting the same amount down. Her loan amount is the same. Her interest rate's the same. And her down payment's the same. The only difference is the property only appraised for $330,000. So if she can get her mind around paying $40,000 more than, what the value of the property in the appraiser's mind, this loan product gets her checks all her boxes. All of her goals are met. The same amount out of pocket, the same loan amount, the same monthly payment. So the 90% loan with no MI is a super, super powerful tool. And I just encourage everybody to, if your guy doesn't have it, call us, call someone else. And I'm not knocking your guy. This isn't a product that everybody has, but it is a product that exists. It's not a flying unicorn. It's not the Loch Ness Monster. It's not, what do you call the big hairy guy? Bigfoot. It's a real loan product, and we're using it daily in our practice for situations like this, and for the simple fact that you can put less money down and still have the no mortgage insurance. So, which is awesome because that avoids you having to petition the lender later to drop the MI. So, super powerful loan program. It exists, 90% no MI. And we are happy to discuss it with you if you have questions. If you're an agent out there and you're listening to this, I encourage you to give us a shout. We'll walk you through how to use this for that very reason that we just talked about, bridging the appraisal gap, because you can do it without upfront mortgage insurance, which is another strategy that we're not going to get into. So I hear the police car sneaking up behind me. Hey, that offer's still out there. If anybody knows what song this is, call or text. I'll be happy to send you a Starbucks card. One of my favorites, lesser known band, but one of my favorites. So we'll be back on the other side of this. I encourage you to call us at 561-291-8569. That's 291-8569 or www.mr.mortgage. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
You heard the big announcer. Give us a shout at 561-291-8569. You can also text that line. Dom's, as you hear, he's managing the text line. So I know a lot of people don't want to hear their voice on the air. Sometimes I don't want to hear my voice on the air. But yeah, so you can call or text 561-291-8569, or as always, visit the website www.mr.mortgage. That's www.mr.mortgage. And speaking of Dom, the producer, and questions, let's jump into another question. What do you have, Dom?
All right, we have David from Jupiter. David says, I want to try to buy something, but I'm afraid the market is going to crash or at least pull back some. Prices seem crazy. Do you think we're in for a market correction?
Hey, David, that was his name, David? Sorry, I missed that. Yeah, David, great question. So, and I know there's a lot of people that have been sitting the fence thinking the same thing, and there's so many intricacies to the market, right? So you have upward pressure in interest rates, appreciation still moving. So even if prices stay flat, like they never appreciate again, that $350,000 townhouse that we used as an example is only ever worth $350,000. It's going to cost you more at 6% to borrow money than at 4%. So just keep that in mind. There is a cost of inactivity. We talked about it before. I mentioned the gentleman in Green Acres who waited another year, signed his lease, and it cost him, I don't remember the numbers. I'll have to go back and pull the notes, but I want to say it was over $50,000. I know it was at least $50,000, but yeah, just think of all of the moving parts in the market when you are convincing yourself to wait it out. And I get it. Prices are crazy. Listen, I was born and raised here. I've lived here my entire life, and I see prices in some of the neighborhoods that I grew up in and played in, and I just, it's hard to imagine, but that's where we are. But hey, listen, gas used to be 25 cents a gallon too. And, my grandfather told me you'd get change for $5 and walk out of the store with a bag of groceries. So I don't know a definitive answer for you, but I can share with you that I've been in the business a long time. I first got licensed as a mortgage broker in 1999. And I mentioned my grandfather. He was a home builder here in South Florida. So I grew up kind of in real estate. We built, the family business, built homes in Royal Palm and Palm Beach Gardens. And, when there was nothing in either of those locations, 95 used to stop at PGA. I don't know how many of you remember that. But anyway, I've seen a lot in this market, and the crash was scary, and it was bad for a lot of people. I know I lost a tremendous amount of money and quite honestly, self-esteem in the real estate crash. And there's similarities. There's no question. We talked about it in the show before. If you look at the chart, we're in a, darn near vertical appreciation cycle. It's scary, but I just caution you to not talk yourself out of it, because there are some very distinct differences. So to answer your question, I don't think we're in for a crash. I do think we're in for a pullback of appreciation. And you've heard me say it before. my gut tells me we're somewhere between 6 and 9% appreciation. Once we get through this pop that we're in now with the pent-up demand and the out-of-town buyers that we've already referenced in this show, I think we pull back to a 6% to 9%. And I referenced my personal experience way back in the day where we were at a 3% appreciation. It still made sense. But the market's very different now. And what I mean by that, when we saw the run-up and then the subsequent crash last time, it was pure speculation. We had the loosest, most dangerous guidelines for lending that I've ever seen, and I don't think we'll ever see it again. You heard the term liar loan. With the right credit score, you needed no documentation. Lenders were throwing 100%. There were even loans out there where you could borrow more than 100%, finance some of your closing costs to buy the property. And all of that was fueled by the appetite of the secondary mortgage market. So there were a lot of secondary market investment opportunities at an institutional level that were created that drove all that money back down to you and I, the consumer. And we used it recklessly. We went out there and it was pure speculation. There were people, regular people. I was quoted in an article in the Palm Beach Post. I'll have to look it up. I'll be happy to share that with you. But I said, I'm afraid for the small business owner who's making $50,000 a year, but he's buying these $1 million speculative purchases. He's putting himself at risk. And what happened was that secondary market money dried up. There was nobody left to sell those properties to. Oh, and just to jump back to that guy, this avatar, if you will, this example, he was buying 6, 8, trying to buy 10 properties. Sometimes I was pulling credit and seeing people with multiple properties. We're not seeing that now. We're seeing people that are fully underwritten, well qualified. And back then we had a lot of adjustable rate, interest only. We had negative amortization loans. You could make a payment less than the minimum required payment, and they would tack the balance onto the end of your loan. So it was reckless back then from the lending standpoint, which fueled all the speculation. This time around, we're seeing, there's FOMO, right? So there's the fear of missing out. They're wanting to jump in. So there's a bit of speculation from that standpoint, but there's more of a fear of being priced out driving the intensity on the buyer side now than that desire to flip the property to the next person in line. It's like that old the old tulip bulb story from Europe. As soon as that last person in line isn't there to hand that burning potato to, the market crashes, and that's what happened. So when the secondary market money dried up, there was no more speculative lending, and then all of those adjustable programs started to adjust. The interest-only periods expired, and there was no demand in the market because that one guy owned 10 properties. So do you think another one guy is going to want to buy his 10 properties? He was having a fire sale just to get out from underneath it. So now I'm not seeing that. I'm seeing well qualified buyers with 1, maybe 2 properties. They might be making a second home purchase. And just recently, moving into probably the third quarter of last year, we started to see a big uptick in investment properties driven by kind of the Airbnb market. But I'm not seeing the average Joe, if you will, carrying 10 mortgages and, living that real estate flipper lifestyle that we see on HGTV. I'm seeing, families that are trying to buy primary residence or more established buyers who may be buying a second home or a vacation home, or some people who are trying to supplement retirement income by buying a couple of investment properties. But they're all putting skin in the game. Down payments are required. There's cash flow analysis on investment properties. So I share that just to say I think the buyer is stronger in this market. And I think the biggest reason why there's not going to be a quote-unquote crash is there's a ton of equity in the market right now. So if somebody got in trouble, they're able to sell their property for a profit without it having to go to foreclosure, and then the bank having to liquidate that on the foreclosure market, which is another reason prices were driven down last time. Also, too, not to get too deep into all of this, but there are institutional investors standing in the sidelines waiting to scoop up large portfolios of non-performing mortgage debt. So it's unlikely that it's ever going to make it to the street level, if you will, which is a big reason why the crash happened last time. So I know that's a lot. That was kind of a big word and fact salad that I just spilled all over you, and I apologize for that. I welcome a conversation if anybody has interest, just give me a call, 561-291-8569. That also rings to my office during the week. But to answer your question, I do not think we're in for a crash. I do, however, believe that we're in for a pullback in appreciation. And just keep in mind, as I mentioned earlier, if that property never appreciates again, that $350,000 house, if you can buy it at, let's say, 4%, it still makes a lot of sense because you're going to pay principal down over time and build equity. Waiting might also allow the time interest rates need to creep into the 5 or 6s, and you just priced yourself out of that $350,000 house anyway. So be cautious, be mindful of the market around you. Don't go carelessly and dangerously out there into this environment, but also, too, don't talk yourself out of it. Long answer to a complex question because there are a lot of moving parts, but I don't think we're in for a crash. If anything, I think we're overdue for an appreciation pullback. So we're going to be back on the other side of this break. 561-291-8569 is how you get us, or visit the website, www.mr.mortgage. That's mr.mortgage. It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. You heard the man, 561-291-8569. That's 561-291-8569 is the anytime hotline, and I do mean anytime. When Dom and I are not here in the studio, that pushes to the office, so you can always reach me on that number. Or the website, don't forget about that, Mr.Mortgage. That's Mr.Mortgage, no .com. Just type in www.mr.mortgage. So you hear me talk about this all the time, right? I'm a big advocate of a rock star real estate agent. And I read something super interesting this week. So Google released a top 10, if you will. Kind of reminded me of the old David Letterman days. But they released an article that said the top 10 jobs people are currently searching how to become, right? So these are people are looking to join these careers. Guess what was on top? Real estate agent. Doesn't surprise me as hot as this market is. Flight attendant was number 2, which kind of blew my mind with all the bad behavior in the air right now. I can't imagine somebody wanting to be a flight attendant. But so there's a ton of new real estate agents joining the market. I saw a study, or a report, a report the other day that NAR said they've never had as many members, NAR, National Association of Realtors, as they do now. So why do I share that? Well, you have more agents than ever before, more people trying to join the industry than ever before. You have a low inventory environment, and you have pent-up demand by buyers. you have a chance of finding an agent that's not very good, because there's a lot of them out there. Here's a story I want to share with you. This is why you want an amazing agent on your team, and why, if you don't have one, I want you to call me, because I will refer you to somebody that I work with regularly who is definitely a rock star. So this is a horrifying story. There's this gentleman and his wife. He's a doctor. They found the home that they fell in love with for $3.2 million. So he had been pre-approved from his lender. There used to be a loan program, and some banks still have it. It's called a doctor's loan. And back then it was a big deal to borrow 90% with no MI. That was before this superhero loan that I mentioned a minute ago. Now everybody can do it, but back then it was just for doctors. This story goes back to 2019. So his agent encouraged him, the market's hot, you need to waive your finance contingency, as well as your appraisal contingency and your inspection contingency. So sure enough, he strokes his check, which was darn near his entire savings, for $320,000. The article goes on to say he's a new doctor, so he didn't have a ton of money in the bank, but he dropped $320,000 into escrow. And guess what happened? The loan that he thought he was qualified for caps at $2 million. His lender never told him that. His lender told him what his ratios had to be. His lender told him, yeah, you're a brand new doctor. You qualify for this program we have. Super excited to work with you. Go out there and house hunt. They never set a cap on his loan. They never shared that with him. So he did his DTI ratio. He qualified for $3.2 million purchase. He dropped $320,000, only to find out he's not able to borrow 90% of $3.2 million. He can only borrow $2 million. So he scrambled during the contract period. He was able to come up with another loan that he qualified for, but it still left him $180,000 short. So guess what happened? The seller kept his $320,000 and then decided to keep his house. So the seller pulled his house off the market, cashed a $320,000 check, all because somebody waived a very key component to the transaction without being aware of the risk associated with it. Now, had that agent and had that lender been in lockstep together and known exactly what his max loan amount was, what his qualifying ratios had to be, there's a chance that he might have been able to circumvent that and qualify, or he certainly would have been able to circumvent it if the property had not exceeded that $2 million cap. So anyway, I share that story. These guys got beaten up, family of 4, 2 kids under 12, husband and wife in their 40s, moving towards their dream home, lost $320,000 because of the advice of their agent. And it's a long article. It's heartbreaking. I'm happy to share it with you. If you want a copy of it, just visit the website, www.mr.mortgage. I'll send it to you. But yeah, get a good agent. If you don't have a good agent, call me. I will get you in touch with somebody who will keep your interests at heart and represent you well. 561-291-8569 is the anytime hotline when we're not on the air. You can reach us there, or www.mr.mortgage. Thanks.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages, right here on The Mr. Mortgage Show.
Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.